Hello everybody and welcome to this video lecture on the accounting cycle. And now we are at step 5, which is adjusting entries. So last class we left off, we did accounting cycle steps 1 through 4 and ended at the trial balance. And at that stage in the accounting cycle, we say that the trial balance is unadjusted. And the reason why it's unadjusted is because the accounts have not yet been adjusted through adjusting entries. So I'm going to talk to you about what adjusting entries are, of course, but before we get there, I want to go over 3 key concepts that you're going to need to understand before you can understand adjusting entries. And those 3 concepts are the time period assumption, the revenue recognition principle, and the expense recognition or matching principle. So first, let's talk about the time period assumption. The time period assumption says the life of a business is divided into a series of accounting periods in which we measure activity for purposes of comparison. Okay? So it's important to break up the life of a business so you can see if you're improving from 1 month to the next or from 1 year to the next. So let me show you an example of the usefulness of accounting periods. Here you see a chart that says revenue growth trends from 1996 to 2017. So what you see here is that there's a separate column for each year. So you can see how 1 year was compared to the other. And this is very useful because we can see right here, we're improving, and then we got a little worse. Oh no, that's not good. But then we improved, and continued to improve for the most part through the rest of the years. Now, if we had just jumbled all of that information together and weren't tracking it by year, we'd have no idea if we were doing better or worse. So this gives us a lot of really good information. But sometimes people ask me, oh, well, how long then should an accounting period be? And the answer is, really, it depends on the business. Now, at a minimum, companies must record their accounting information on an annual basis or every year. And the reason why is because of tax purposes, right? Every year you have to pay taxes. So that means every year you have to track how much money the business made, so then you can pay the taxes on how much money you made that year. But most companies want to see their financial information and to know if they're doing better or worse throughout the year, not just at the end of the year. So most companies use monthly accounting periods. They want to track it every month so they know how they're doing and can make those changes throughout the year rather than just at the end of the year. Okay, so that's the time period assumption. Now let's move on to the revenue recognition principle. But before we go there, let's first refresh our memories on what revenue is. Revenue is an increase in equity from sales of products and services provided to customers. So in an example that we've seen before, here we have the company providing consulting services to the customer, and the customer is paying them in cash right away. So when we do our transaction analysis, we have our asset of cash going up, and we have our equity going up because revenue increases equity because it's the process of making money. We're providing services. But there are situations where there may be timing differences between when the cash is received and when the work is performed. Sometimes it could be that you receive the cash before the services are performed. Sometimes you receive the cash after the services are performed. So this causes a lot of confusion. When do I record the revenue? Do I record it when I receive the cash? Or do I record it when I've done the work? I don't know. Well, to help us answer that question, we have to look at our accounting rules. Okay? Now, accounting rules, think of it kind of like, again, with sports. There are rules in sports to help you figure out what happens in these confusing situations. So, for example, if you're playing soccer and somebody kicks the ball out of bounds, what do you do with the ball? Who gets it? Is it the red team or is it the blue team? And how do we go about getting the ball back into play? Well, you need rules so that everybody knows what to do in these situations when we're confused. Same thing with accounting rules. Now, the accounting rules that we use are called Generally Accepted Accounting Principles, or I shortcut it to GAAP. Okay. Now, GAAP is the accounting rules that apply to U.S. companies. There's a separate set of accounting rules that apply to international companies, and we call them International Financial Reporting Standards, or IFRS, or I sometimes call it IFRS. And I just want you to know that there are these two different sets of rules. That for the most part, they are very similar. There's just a few small differences. In this class, though, we're only going to be learning about generally accepted accounting principles. But I just want you to know, in case you're ever looking at the financial information of an international company and it looks different from the things we're talking about in class, that's the reason why, okay? Because they follow slightly different rules. So what do the accounting rules, or GAAP, tell us about what to do when we're not sure when to record our revenue? Well, the rule for that is the revenue recognition principle, which says revenue is recognized at the time the products or services have been provided to the customer. Or in other words, when it is earned. Okay? So that word earned means putting forth effort or doing work. And it's at that time when you've done the work, you've put forth the effort, that you've earned the revenue. Okay? And that is regardless of when you receive the cash. Whether you receive it before or after doesn't matter. It's the work, when the service is provided, that equals revenue. Cash does not equal revenue, okay? So we don't worry about when the cash is received. I mean, we do worry about it. We want to make sure we receive the cash. But in terms of when we recognize the revenue, it doesn't matter when the cash is received. Okay? So now let's move on to the expense recognition or matching principle. And so again, I want to refresh your memories on what expenses are. Expenses are a decrease in equity from costs of products or services used up in providing products or services to customers. So we're going to use an example we've seen before, which is rent. Okay, we pay our landlord for rent in a given month, say the month of April, and we're going to use the office space for that same period of time, the month of April. So when the cash is paid in the same period that you're using the service, it's very straightforward, okay? We do our transaction analysis. We see here, okay, our cash went down because we paid cash, and our equity went down through the expense account because expenses reduce the money that we make, take away from the money that we make. And of course, the owners can claim the money that a business makes. So if it's taking away from the money the business makes, it's also taking away from equity. But there are situations, again, where the cash may be paid before we use the services, or the cash may be paid after we use the services. And that can cause some confusion. When do we recognize the expense? So the rule that we use there is called the expense recognition or matching principle. Expenses are recorded at the time goods and services are used. Doesn't matter when the cash is paid. What matters is when the goods and services are used. Now we call this the matching principle because remember, revenues and expenses are related, right? Expenses is the cost of goods and services used to generate revenue. So you want to make sure that you're matching the expenses with the related revenues, right? So we want to track all of the things we used, whether that's our supplies, our employees' services, our rent, our insurance, all the things we use to generate this revenue. We want to track exactly what we used to generate this same revenue in that month or in that accounting period. So if you use this expense recognition or matching principle, it helps to ensure that these two things are matched up. So we have a pretty accurate picture of how much money the business made. Now, because we say that we're going to record revenue when it's earned and expenses when they're used up, regardless of when cash is paid. We say that GAAP requires the accrual basis of accounting. Okay, so there are two different methods of accounting: accrual basis and cash basis. Okay, now cash basis is the one that is really more intuitive for most people. Okay, we think that revenue is recorded when cash is received, and that expenses are recorded when the cash is paid, and that's what we are conditioned to think about. And it's certainly a much easier method because it's very obvious when you receive cash, right? When somebody hands you cash, when you get your paycheck, you get super excited, right? Like, I received money. I feel this money. I feel this check in my hands. It's obvious. I know I got it. Okay. But it's not so obvious when you record revenue when it's earned. So for example, if you're doing work and waiting for your paycheck, you actually have earned revenue while you were doing the work. Even if you have to wait 2 weeks to get paid, but you think, oh, I made money when I got paid. So it's obvious when you get paid. It's not so obvious when you're doing the work and you haven't received anything yet. Same thing with expenses. When you have to write that check or hand over cash out of your wallet, it's very obvious. You feel it. It hurts. And so you know it's happening, but it's not so obvious when you are forced to record expenses as you've used them, because sometimes you don't even notice that you're using something, right? I mean, think about your cell phone. You use your cell phone every single day. So technically, you're incurring expense every single day, but you don't notice it until you have to pay that bill, until you have to write that check or have the money taken out of your account. Then it's much more obvious. So yes, cash basis is definitely easier, more obvious, more intuitive than the accrual basis. But there are major flaws in the cash basis of accounting. And we're going to talk about those flaws in class. And hopefully through that exercise, you're going to understand the flaws in the cash basis. And so because of those flaws, GAAP requires the accrual basis. And so that is what we're going to follow in this class and what we're going to learn in this class. And what we use in order to carry out the accrual basis is adjusting entries. Okay, so adjusting entries occur whenever there's a timing difference, when revenues and expenses don't match cash, when it happens in a different time period. You need adjusting entries. And adjusting entries are entries made at the end of the accounting period to recognize revenues and expenses that occur in a different period than the cash. Okay, so I'll give you some specific examples of these timing differences. But for now, for this first part of the video, I really just wanted to make sure that you understood those three key concepts: the time period assumption, the revenue recognition principle, and the expense recognition or matching principle. Because if you understand those three concepts, it's going to help you better understand those adjusting entries. So stay tuned for the next video when I'll give you some examples of those specific timing differences.